In an emergency, firefighters rely on multiple tools to control the situation effectively. They don't just use water, they combine different techniques to make sure the fire is completely extinguished. Similarly, in trading, relying on a single indicator can lead to false signals. That's why we use the Dual RSI strategy, which combines two RSI indicators with different periods to filter out noise and confirm high probability trades. In this video, I'll teach you this strategy in detail and show real examples from the New York stock market. Stay with me until the end, and let's dive in. Understanding RSI periods. The RSI analyzes price changes over a specific period, typically 14 days, and calculates the average gain-to-loss ratio. Then, a formula is applied to generate a value between 0 and 100. The detailed calculation of RSI is explained in a separate video, which you can view through the link above. The RSI period refers to the number of price bars the indicator considers when calculating its value. A shorter period, such as 7 or 9, makes the RSI more sensitive to recent price movements, helping to identify short-term trends and reversals more quickly. On the other hand, a longer period, like 14 or 21, smooths out price fluctuations, offering a more stable view of the overall market trend and reducing noise. The choice of RSI period depends on the trader's strategy and the time frame they are focusing on. Required tools. Every trading strategy relies on two main tools. 1. An indicator or tool to analyze the dominant trend. 2. An indicator or tool that generates buy and sell signals. However, only signals that align with the trend are considered valid. The Dual RSI strategy also consists of two RSI indicators, with different periods, to filter out false signals and confirm high probability trade setups. RSI 1, Short-term RSI. Set to a lower period, like 7 or 9, to react faster to price movements. RSI 2, Long-term RSI. Set to a higher period, like 14 or 21, to smooth out noise and identify the overall trend. How to use the Dual RSI strategy. Buy signal, long entry. To get a buy signal, we first check the long-term RSI. If it is above 40, it indicates an overall bullish trend. Then, we look at the short-term RSI when it crosses above 30, signaling a move out of oversold conditions, and that is the buy signal. Together, these signals confirm a strong upward momentum shift. Sell signal, short entry. For a sell signal, we first check the long-term RSI. If it is below 60, it indicates an overall bearish trend. Then, we look at the short-term RSI. When it crosses below 70, signaling a move out of overbought conditions, and that is the sell signal. Together, these signals confirm a strong downward momentum shift. Real-world market examples. This is an example from the New York Stock Exchange, specifically Tesla stock. As you can see, we've placed two RSIs on the chart, one with a short-term period of 9 and the other with a long-term period of 21. In the area after the gray line, we can see that the long-term RSI is above 40, indicating an uptrend. Therefore, we are looking for a buy signal from the short-term RSI. When the 9-period RSI breaks above the 30 level and exits the oversold zone, a buy signal is generated. Following this, we can observe that the stock price has experienced an upward movement. Similar to the previous example, this setup focuses on a sell signal. Here, the long-term RSI is below 60, indicating a downtrend. In this case, we wait for confirmation from the short-term RSI. When the 9-period RSI drops below 70 and exits the overbought zone, a sell signal is triggered. Following this, the stock price moves downward. We've reached the end of today's video. Make sure to practice this strategy and see how it works for you. If you found this helpful, don't forget to like, subscribe, and turn on notifications for more trading tips. Let me know in the comments what's your favorite RSI setup. See you in the next one.